They are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, what America is doing to China will change everything. And if you're wondering which side is panicking, you're going to be shocked to find out who and why. We're also seeing renewed stress in the U.S. economy that could shut down the entire manufacturing sector as deadlines are now looming. We also are seeing another sector of the economy which many experts said could not come crashing down, that it was immune to any of the effects we're seeing. We made the case on this show that yes, it would come crashing down, and it's happening now. And if you're wondering what we're doing at the Chevron headquarters in Houston, Texas, well, their CEO has made one of the most outlandish claims we've ever heard. Plus, we have a recent sponsor who's back on our show today, who's now appointed the former CEO of Barclays Bank as its chairman as it looks to establish a global presence. And we're making the continued case while their stock could make a 40% move to the upside. Stay tuned to the end of the show for more information, or check out the pinned comment or description below. Now let's head over to Bloomberg, where we picked today's story up with a headline. The UAW warns it will expand strikes if no serious progress is made by Friday. And we can really see here that the upper hand is in that of the UAW, because when you see periods of high inflation, well, that gives a lot of unions and negotiating power they need to get higher wages. But there's a whole other factor that's really pushing the cards to their side of the table. The United Auto Workers said more of its members will go on strike at General Motors, Ford Motor, and Stellantis NV facilities starting noon this Friday unless substantial headway is made toward new labor contracts. Either the big three get down to business and will work with us to make progress in negotiations, or more locals will be called on to stand up and go on strike. And really, when you take a look at the labor force participation rate, well, this is the percentage of age-eligible workers who are choosing either to work or are looking for work. You'll notice it's at 62.8%, at rather low level, suggesting, again, there just isn't enough labor out there to avert a shutdown if the unions don't get what they want. They know the power, the cards, all the chips are on their side of the table. It's only a matter of time, because if more workers step out of these factories, you're going to see the small and mid-sized manufacturing suppliers, well, they're going to be forced to shut down too. They don't have the cash. They don't have access to the banks like everyone else has right now, and that's going to cause major economic problems until, of course, we see, as we know what will eventually happen, the policymakers will eventually step in and try to shut the strike down unless a negotiation comes out quickly. And here we can see the U.S. housing starts drop now to the lowest level since 2020, while permits seem to continue to rise. And we keep hearing about the strength in the housing market, and we've been making the case why that is going to change in a big way. And as you can see now, U.S. home construction dropped in August to the lowest level since June of 2020, highlighting the toll of declining affordability. Of course, this is going to be the continued case that interest rates are too high. We're making the case it's not a function of interest rates. There's entirely a different reason behind this decline. Residential starts decreased 11.3% last month to 1.28 million annualized rate, a largely driven by a sharp decline in multifamily construction or apartments. You can see that is a staggering large decline. Meanwhile, applications to build, a proxy for future construction, picked up to 1.54 million, the most in nearly a year. So some of the good news here is permits to build one-family homes accelerated to the fastest pace since May of 2022. Indicating optimism about future demand. Of course, we know that not necessarily just because they're pulling permits that they're building, but what we're seeing here is a change by the home builders as they cease to build as many multifamily homes and now look, of course, to single family homes. In a sense, as we've been making the claims, it's not about rates, it's about the banks. The recent pickup in mortgage rates has helped drive housing affordability to record lows, suppressing demand, which you wouldn't get the picture based on housing permits. Mortgage applications for home purchases are now at levels not seen since the mid-1990s, and it's not clear when borrowing costs will subside. Of course, we'll know as soon as the Fed gets back to zero, which is coming in the not-too-distant future. With homeownership out of reach for even more Americans, builder sentiment has soured to a 5-month low. And that said, with existing home inventory still extremely limited, there's opportunity for builders to capture more prospective buyers. And we've been making the case that this optimism by home builders would eventually change. And sure enough, here you can see it on this chart. Home builder confidence in green was just off the charts. Home buyers, well, they're not confident at all. And again, everyone thinks it's a function of interest rates, and yet, as you'll see, it's not. Eventually, you're going to see the sentiment of builders come down, and of what that will then translate to is a sharp decline in new home prices as they look to compete with the existing sellers. Here you can see new privately owned housing units started that in blue against 30-year fixed rate mortgages. And so the notion that this has anything to do with higher rates, well, you can tell it doesn't really matter too much, because you'll notice we've seen rates steadily decline. And while going into the global financial crisis, we can see that new privately owned housing starts for total units went down. So it's not the case, but you can see the relationship right now. It makes sense that this is what everyone sees as rates are going up. Demand has to be coming down. It's a function of tighter monetary policy and the Fed getting what they want. But in reality, it has everything to do with the banks, because if you think about it, in a booming economy, then we should have no problem absorbing higher rates. Wages should be growing, more hours should be worked, people should be prosperous. They should have no problem saying, hey, you know what? I can afford these higher interest rates because the economy is growing and I'm going to be a part of it. The problem is not rates right now. It's that people can't get a loan from the bank. Of course, the home builders, they don't see that. But eventually, I think a lot of these permits are not going to turn into starts. And here you can see a new privately owned housing unit started against the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. Now, why are we using that instead of, say, the net percentage of banks tightening standards in real estate loans? Well, not only is it about the same cycle, but there's a lot less data. And we can look back here and see at periods, indeed, when banks are tightening, that's any time the red line's above that dashed horizontal green line, what we know is typically housing starts are coming down. We see it here going into the dot-com bubble. What happened? Banks started tightening standards. Next thing you know, housing starts started to slow. We see it. Look at this in the global financial crisis. They weren't tightening standards. They were just easing less, and that was all it took. And then, of course, as banks tightened, housing starts came plummeting down. And now we're seeing again, and despite the fact that builders are kind of optimistic here, suggesting that maybe it has to do with rates and that the economy is going to turn around and the soft landing is going to happen. The reality is, as long as the yield curves remain inverted and the banks continue to keep lending standards tight, we're going to drain money out of the system, and everything eventually comes crashing down. But one CEO, at least that at Chevron, says oil prices aren't coming down at all. Of course, we're making the case they are. As oil prices are on track to hit $100 a barrel, but the economy can handle it, according to Chevron's CEO. And if you believe that and you've been following our CTA-Timer Pro trade, well, you can check out the link in the description and still get a 14-day trial with your money back if you're not happy, because the machines were leading this, and now we're seeing the news follow it. Will have some effect on the economy, but we've had relatively higher oil prices here for now most of this year, and certainly all of last year, and the recession that everyone's been talking about hasn't arrived. So you think if it hasn't come, it's not going to happen. So he says, I think the underlying drivers of the economy in the U.S. and frankly globally remain pretty healthy. So I think it's a drag on the economy, but one thus far I think the economy has been able to tolerate, and so far it has. The only question is for how much longer, and you can see here on this chart, we have the consumer price index showing demand against the crude oil prices. Now, crude oil shown in dollars per barrel, of course, consumer price index year-on-year rate of change. And normally we know there's a pretty good relationship, because where crude oil goes, gasoline prices go. And we know energy is a big component in the CPI. But I want you to see the specific period here, roughly around 2013 to 2015. You see crude oil prices staying high. You see inflation was coming down, a sign the consumer actually demand was falling, and as demand continued to go down, look what happened. Crude oil prices, reverse direction, came crashing down. And there's a reason behind that. as we look here into total compensation, because we have the average hourly earnings of production and non-supervisor employees multiplied by the average weekly hours they work. So if you think about how this all plays out, and when energy prices go higher, people need to be able to afford them. That's key. And if they can't, then they have to make cuts to their discretionary spending in other areas, and eventually those higher oil prices, those higher energy prices start to bite. And look what happens. We look back at that same period here, roughly 2012 into 2015 and 2016, and look what happened. Oil prices are rising, but total compensation here shown on a year-on-year rate of change was slowing. People couldn't afford it. And next thing you know, of course, we almost have a global recession, and oil prices come crumbling back down to reality. Right now, oil prices are rising. Here you see the Chevron CEO saying people can afford it. We're saying we can't, which makes it purely a speculative trade to the upside. Of course, as we've noted, our machines positioning report nailed it perfectly. But now let's talk about what's going on in China, because between the U.S. and China, we're seeing panic start to set in. And many of you are probably thinking it's on the side of China. Well, you're about to be surprised. It's not China who's worried. It's us. As American business confidence in China slumps to lowest in decades. And here we can see U.S. companies are painting the bleakest picture in decades over doing business in China, as tensions between Beijing and the West are compounded by a deteriorating environment for their operations. Now, why would U.S. businesses have an issue here? Because they've outsourced a lot of their factories over to China. The labor is cheaper there. And as having those factories there, they're hoping, and they have been benefit from the growth, the internal growth of China. So if you see China start to slow down, well, these factories, maybe they move them somewhere else, but eventually it backflows to layoffs in the U.S., and that's what U.S. policymakers are suddenly worried about. Just over half of the 325 members surveyed by the American Chamber of Commerce in Shanghai were optimistic about their 5-year business outlook, the lowest since the survey began in 1999. Of course, we know that when optimism goes down, spending goes down, and layoffs, well, they go up. And China's deepening economic slump is damaging the fortunes of U.S. companies with deep roots there, with some growing increasingly pessimistic this long-awaited post-pandemic boom will materialize. And so we've talked about this on the show before. As corporate profits start to come down, companies get under pressure to maintain their stock price. And of course, under periods where we've had high inflation, there's just not a lot of places employers can cut. But there's one place they can, and that's the head count. And that's what eventually happens when things start to slow down and optimism starts to tank. The American Chamber survey was conducted between May 31st and June 30th, and since then, the Secretary Gina Raimondo visited China on a 4-day tour that included meetings with Chinese officials and discussion with U.S. business leaders. The visit represented good progress, and here's why we're panicking in potentially improving conditions for businesses, according to the Chamber's chairman. So what we can note here is what we're worried about is a broad slowdown in China that will eventually affect U.S. businesses. And of course it will, because we're in a globally synchronized economy, and that will flow back to the U.S., lead to layoffs at a time where nobody here thinks the U.S. economy can slow down, and they've been claiming that we're immune from any downturn in the Chinese economy. And here you're starting to see panic set in, and that we need to get over there and start to get, of course, things turned around, and hopefully get their economy turned around, because there's a secondary effect. If China's economy is slowing, well, that means the export of dollars around the world slows, trade further contracts, you get a recession, maybe worse, a financial crisis, potentially even a depression, and in a period of massive debt loads, we know the banks come crumbling down. In China, the banks are under stress from their property sector. The U.S. small and mid-sized banking sector never recovered from the March downturn. So you see, we're on the brink. If things don't turn around and quick, well, everything comes tumbling down. And China and foreign companies have both prospered in the past decades as foreign direct investment grew, while policymakers now appear to be emphasizing self-reliance. Of course, that means bringing jobs back home, and that's not how the global economy works. And here you can see this headline now: China's worst capital outflow in years spells more yuan pressure. The bigger issue is capital outflow means China's economy shrinks, means their real estate sector shrinks, means their banking sector hemorrhages. Are you starting to see that this is how this is all coming to an end? We've been making the case that China is the epicenter of the next global financial crisis. As money flees out, they've got no chance to save it at all. Of the $49 billion outflow from the capital and financial account last month, $29 billion came from securities and investments, according to the State Administration of Foreign Exchange. While inflows have picked up a bit, an even larger amount fled that pushed the balance deeper in the red and is threatening to topple the entire Chinese economy. And now you can see why all the talk about the Chinese real estate sector matters, because here you see Country Garden leaves bondholders in the dark as interest is unpaid. Of course, we've noted there's a global dollar shortage, and as money flows out of the country, it means that those who need money have less access to it. The banks don't have the capacity to lend a lot there. We know that Beijing will eventually put pressure on them, but if there's not enough money, eventually the system breaks, the dominoes start to fall, and it goes all throughout the world. And here we can see Country Garden perhaps coming down fairly soon. As distressed Chinese developer Country Garden Holdings has passed the initial deadline to pay dollar bond interest, with the holders yet to receive the money, keeping the threat of a first default looming. Of course, my friends, that is a dangerous situation. But one thing that we are bullish on is our recent sponsor here. This is AGBA, or AGBA, and they've been on the show before. As you may remember, they're a one-stop financial supermarket. They just had a big announcement. Of course, we've got all the information linked in the description and the pinned comment below, as they appointed Bob Diamond as a chairman and announces Atlas Merchant Capital as strategic advisor. Of course, we're making the case, and we continue to make the case, of why we think their stock can move up as much as 40%. Let's take a look at this press release. We'll take you through the chart setup, as you'll soon see. Here we can see they have now appointed, as we mentioned, Mr. Bob Diamond. He brings decades of financial service experience and established leadership track record, as well as deep credibility in global finance, to the board. He is the CEO of Atlas and formerly served as the CEO of Barclays Bank. And Atlas is a global investment firm founded by Mr. Diamond and Mr. David Shamus, offering debt equity investment strategies to invest in public and private markets through differentiated expertise in financial services and credit markets. And of course, all this means is we see potentially upside for their stock as they look to make this bring on. And the reason they're bringing on Bob Diamond is to establish a global presence, and with that, we believe it's going to be the catalyst for a lot of attention on their stock and drive it up from its current price to the 50-day moving average, which would realize approximately a 40% gain. And here you can see, based on this recent chart, looking at the 6-month history here, that we see the RSI coming off deeply oversold territory. Of course, traders are looking to this. We see the MACD positive cross, still in oversold territory, but moving higher. So we're seeing momentum slowly build here. And there's a wall at around 71 cents. Its time of recording price was trading just slightly below that. We see where the sellers are at. If we break through that, we think the upside target, again, that green line there, the 50-day moving average. Let's zoom in a little closer, because what do we see right around that 99-cent target where the 50-day is at? Well, what do we know? There's a bunch of volume profile. We're seeing sellers before here. And what do we know? The last time it broke over this wall, this volume profile wall of sellers, the stock price went straight vertical. A case that we're making could happen again in the not too distant future. Of course, as always, with any company we feature on this show, you're under no obligation to purchase their stock. Be sure to do all of your research before buying or selling anything. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.